All right, welcome to the Explainer. If you've ever bought, sold, or even earned a single Satoshi in crypto, this one's for you. We are about to pull back the curtain on the one topic every US crypto investor kind of dreads but absolutely cannot ignore: taxes. Look, getting this wrong can be a huge headache, but don't worry, we're going to break it all down step by step. Let's just dive right in.
And let's be super clear here. This isn't just some scare tactic. The IRS gets data dumps directly from exchanges like Coinbase and Kraken. They have incredibly sophisticated software that can trace transactions right on the blockchain. So, this whole idea that crypto is some anonymous tax-free zone, that's just a dangerous myth that could get you in a lot of trouble. Understanding this stuff isn't just smart, it's pretty much your only line of defense.
Okay, now before we go even one step further, we have to get this out of the way, and it's really important. This explainer is for educational purposes only. This is not tax advice. Your situation is unique. Tax laws can get complicated and they change, so please consult with a qualified professional who can look at your specific circumstances.
So, here's our game plan for today. First, we're going to cover the single most important rule the IRS has for crypto. It changes everything. Then we'll get into what actually triggers a tax bill, how to do the math on what you owe, and yeah, we're even going to venture into the wild west of DeFi and staking. After all that, we'll wrap up with a clear action plan and the biggest mistakes you've got to avoid. Sound good? Let's do it.
All right, first things first. This is the foundation for everything else we're going to talk about. If you take away just one single thing from this whole explainer, let it be this: the IRS does not see crypto as money. They see it as property. And that one little distinction, well, it changes absolutely everything.
So what does that actually mean, property? It means that in the eyes of the government, your Bitcoin is treated just like a stock, or a piece of real estate, or even a collectible baseball card. And because of that, pretty much any time you sell it, trade it, or spend it, there's a potential tax consequence. This is the key that unlocks this whole puzzle.
And this chart right here just lays it out perfectly. When you use $1 to buy coffee, it's just a simple exchange. No tax man comes knocking. But when you use one Bitcoin to buy, say, a car, the IRS sees that as you selling your Bitcoin for its US dollar value at that exact moment. Any profit you made from when you first bought that Bitcoin is now a taxable gain. It's a total mind shift. Okay, so we've got the crypto is property rule down. Now let's get practical. How does this rule actually apply to the stuff you're doing every day? This brings us to what are called taxable events, the specific actions that actually put you on the hook for taxes. Okay, this slide is huge, so let's really dig in. Selling your crypto for US dollars, that's an obvious taxable event. But here's the one that trips up so many people, that second line on the left: trading one crypto for another. When you swap your Ethereum for some hot new altcoin, the IRS sees that as you selling your Ethereum. You have to calculate a gain or a loss on that trade right then and there. Now on the flip side, just buying crypto with dollars or moving it between your own hardware wallet and an exchange, that's not taxable. Okay, so we know what gets taxed. The next big question is, how much? How much do you actually have to pay? This is where we get into the nuts and bolts of capital gains and losses. The single biggest factor here is time. How long did you hold the asset? If you buy and sell a crypto within a year, any profit is considered a short-term gain. It's taxed at your normal income tax rate, which can be pretty high, up to 37%. But if you hold that same crypto for more than 1 year, it becomes a long-term gain, and that unlocks these much lower tax rates. It's a massive financial incentive to hodl.
I mean, just look at this. The picture says it all, right? That giant gap between the blue bar and the orange bar can mean thousands or even tens of thousands of dollars back in your pocket instead of Uncle Sam's, all depending on how long you held. So, to figure out your actual profit or loss, you need to know one magic number: your cost basis. It's basically what you paid for the crypto in the first place, including any fees. The formula is dead simple: what you sold it for minus what you paid for it. But here's the thing. Without an accurate cost basis for every single transaction, you're basically flying blind, and you can't calculate what you owe.
Okay, but what if you've been dollar cost averaging? Let's say you bought Bitcoin at 20 grand, and then you bought more at 40 grand. Now you want to sell. Which Bitcoin are you actually selling? This is where accounting methods come in. The default is FIFO, or first in, first out, so you'd be selling that first Bitcoin you bought. But a method like specific ID gives you way more control. You could choose to sell the more expensive coin to maybe harvest a tax loss. The key is, Just pick one method and stick with it.
Okay, grab your snorkel, because we're heading into the deep end now. For all of you messing around in DeFi, staking, liquidity pools, NFTs, this is where the rules can get really murky. The official IRS guidance is still trying to catch up. So in this world, keeping meticulous records isn't just a good idea, it's an absolute must.
And this is probably the #1 question we get from people in this space. You're helping secure a network, you're earning some new tokens as a reward. So how does the IRS look at that? Is it a gain? Is it a gift? What's the deal?
The answer is, the IRS treats it as income. The second those staking rewards hit your wallet, their fair market value, their dollar value at that moment is considered ordinary income, just like getting a paycheck. But here's the kicker. That value also becomes the cost basis for those new tokens. So you're taxed on them once when you receive them, and then you're taxed again on any future gains when you eventually sell them. Yeah, it's a thing. And man, the complexity here can be just mind-boggling. Just look at this list. A single DeFi action, like providing liquidity to a Uniswap pool, might feel like one move, but it can actually be 3 or more separate taxable events. This right here, this is exactly why using crypto tax software or hiring a crypto-savvy professional becomes almost non-negotiable if you're an active DeFi user. Okay, I know that last part was a lot, and it can feel super overwhelming, but stick with me. We're going to shift gears now from the what to the how-to. We're going to lay out a clear, actionable game plan to get your crypto taxes filed and done right. Look, it really boils down to 4 main steps. Step 1, and this is the big one, track every single transaction. Use software like Coinly or CoinTracker to make your life a million times easier. Step 2, every sale or trade gets listed out on a form called the 8949. 3, you take the totals from that form and put them on Schedule D. And finally, Step 4, any income you made from staking or airdrops, that goes on Schedule 1. See? Breaking it down makes it way less scary. All right, now for a little bit of good news in all this tax talk. If you have more losses than gains, you can use those losses to offset your gains. And even better, if you still have losses left over, you can deduct up to $3,000 against your regular job income each year. This is called tax loss harvesting. And here's the best part. For now, crypto doesn't have the wash sale rule that stocks do. That gives you a huge strategic advantage for managing your tax bill.
All right, we're almost at the finish line. To wrap this all up, let's just quickly go over the most common and often the most expensive mistakes that we see crypto investors make. If you can avoid these traps, you are way ahead of the game. Okay, think of this as your final checklist. Just don't do these 5 things. Number 1, not reporting at all. You'd be surprised, but don't be that person. We've hammered home number 2, thinking crypto swaps are tax-free. But the one I really want to emphasize is number 5. Do not wait until April 14th to try and sort through thousands of trades from the last year. It is an absolute nightmare. Trust me, track as you go. So if you remember nothing else from this entire explainer, remember this. Be meticulous. Track every single transaction right from day one. The complexity can snowball so fast, and if you ever feel like you're in over your head, the absolute best investment you can make is getting professional, expert advice from someone who actually understands this space. And that is a wrap on our crash course in crypto taxes. We hope this helped. Join us next time when we are going to tackle a morbid, but an absolutely essential topic, crypto estate planning. What happens to your Bitcoin when you die? How do you make sure your family can actually access your assets? We're going to explore all of that and more. See you then.